All right, so this is chapter 8. And if you've looked at chapter 8 in the book, there's a lot there. This PowerPoint will hopefully, and it should, use this as your guide for this and the practice problems, I should say, for the topics that we're actually going to cover, because we are scaling down chapter 8. Pay particular attention to both the PowerPoints and the practice problems, because since we've narrowed things down, the PowerPoints and the practice problems should point you in the direction of what is important for our purposes. Not that the other topics aren't also important, but there's just not enough time in the semester to cover all of these items. So we have to stick to the things that are the most important out of these. And so let's scroll to the next slide. So what we're going to talk about for the most part in chapter 8 is tax deferred acquisitions. And I realized as I was going back through this PowerPoint, getting ready to do this video, that I hadn't really put an appropriate title on this slide so that you could understand what these judicial principles really relate to. So the majority of our conversation for chapter 8 is going to be around section 351 of the Internal Revenue Code. And what that does, what section 351 allows, is it allows taxpayers to organize a corporation in a tax-deferred manner under section 351. Okay, so what does that mean? So it encompasses acquisitions and dispositions of corporate assets, so that you don't have to reorganize and have an immediate tax impact. So what have we got? So then we have these three judicial principles, okay? And essentially what these judicial principles do, these judicial principles are necessary. You have to meet all three of these items if you want to qualify for a tax-deferred reorganization under section 351, okay? So continuity of interest, all right? So if you're reorganizing, shareholders of the acquired corporation have to retain a continuing interest in the target, okay? Continuity of business enterprise, you must continue the corporation's historic business or continue to use a significant portion of the historic business assets. And then you have to have a business purpose not related solely to tax avoidance in order for this to qualify as a tax-deferred reorganization. Okay, so that's what those judicial principles refer to. All right, so what about if we're transferring property to a corporation? Okay, so again, section 351 is the section of the Internal Revenue Code that allows for these tax deferral provisions, but there are always requirements, okay? So transfer of property to the corporation in exchange for stock. If you receive boot, so anything other than stock, all right? Boot can be assets or boot can be cash, okay? Then you're going to have to recognize some gain, all right? And then the transferors of the property must be in control of the corporation immediately after the transfer. So, and control is defined as 80% of more of the corporation's voting stock and each class of non-voting stock, okay? So two things to remember here. if you are transferring property to a corporation and you want it to qualify for Section 351, if you get any kind of boot, that is going to trigger a gain, okay? And then you must maintain control, and control is defined as 80% or more of corporate ownership following the transfer. I do want to add one item regarding this gain, okay? There is a limit to this gain, all right? And the limit is the lesser of the fair market value of the boot received or the gain realized. All right, and remember, realized and recognized are not the same thing, okay? All right, so now moving on. How do you figure out the tax basis of your stock when boot is received? Okay. Well, this is the formula to do that. Okay, and I'm not going to read all of these items on the slide, but it's important for you to have this formula. So again, I want to make sure we understand what's going on. The shareholder is contributing sometimes cash, sometimes other property, okay, to a corporation, and then receiving stock of that same corporation, okay? So that's what's going on. And then I want to say one other thing. This is tax basis of the stock received by the shareholder. Okay, so this is from the shareholder's perspective. All right, now if we move to the next slide, this is from the corporation's perspective. So now each asset that is contributed to the corporation, all right, you have to figure out each asset's tax basis. And so remember, this is by the corporation. So this is what is going to go on the corporation's like depreciation schedule, for example, if we're talking about a depreciable asset. Okay, so I think it's important to understand what you're looking at. Okay, if you are wanting to contribute cash or property to a corporation, there are a variety of ways that you can do this. Okay, now we're talking here about contributions to capital. What does that mean? That means that a taxpayer is transferring property to the corporation, but the taxpayer is not receiving stock or other property. All right, so in this situation, here I'm going to move this way. What happens? So in this situation, okay, in this situation, the shareholder doesn't receive any property in return or any additional stock. So what happens? Okay, so the corporation takes a carryover tax basis in the property. So if I contribute my Jeep to a corporation, that corporation would take over the tax basis in my Jeep. Okay. if I was a shareholder. If I was a non-shareholder, it would take a zero tax basis in that property, okay? And then if I was a shareholder, all right, what would happen? Well, I'm not getting any new property or additional stock, so my tax basis in existing stock increases by the tax basis in the property contributed. Okay, that's how you deal with that situation. Now, Section 1244 represents a special situation for small corporations. Okay, so if we're dealing with a small corporation and you're the original shareholder, then you have some additional benefits because you can potentially recognize ordinary losses as a result of these tax deferred transfers. Okay, so two basic types of corporate acquisitions are possible. So when you're looking to potentially purchase another corporation, you can either purchase stock or assets, right? And it can either be taxable or tax deferred to the seller, okay? Now, there are some advantages of each, all right? A taxable asset acquisition, so if I'm going to buy a landscaping company, I don't get to buy the name, but I get all of the assets. So all of the lawnmowers, trucks, trailers, all of that stuff, okay? If I buy it in a taxable acquisition, then I get whatever the fair value of those assets. My tax basis is now the fair value of those assets, okay? However, if I decide to purchase the stock or a tax-deferred asset acquisition, the tax basis of the assets stays at carryover value, okay? So if they were assets that had been depreciated, okay, like what if they had used Section 179 depreciation and they were fully depreciated, okay? My tax basis would remain at carryover value, okay? Now, why might I want to acquire another company? Well, there are lots of reasons, right? I might want to diversify. I might need raw materials. So maybe this company supplies raw materials that I'm interested in. Maybe it's in a different geographical market. Maybe there's a new type of technology that this company has. Or maybe they're really good at selling. Maybe they have really well-proven distribution channels. And I'm looking to be able to distribute my products better, okay? So those are why I might be looking to acquire. But remember that I can either buy stock or assets, right? And either in a taxable or tax deferred situation to the seller, and then I have to consider those issues. All right, so let's talk about taxable acquisitions. So what is a very common thing to occur? A very common thing is cash purchases of stock. Okay, so you've got a public firm, you want to buy up all the stock of that public firm. That is a pretty, I'll say, easy way to do it. And the reason it's easy is because you acquire all of its tax benefits or liabilities, its legal identity, and then it becomes a subsidiary, okay? And then you can liquidate or merge or you have a lot of options that way, okay? So these are very common for public firms. You could also do a tax-deferred acquisition, and we've already talked about these a little bit. And so Section 351 allows us to do a tax-deferred reorganization, okay? So you acquire corporate assets, all right, including any of its subsidiaries' stock, and then you can sell those assets if you want, or keep those assets, and you can use this to restructure your capital structure. All right. What about a complete liquidation? All right. So a complete liquidation is essentially a corporation buys up all of its available stock, and then that corporation ceases to do business. All right. There is a form that needs to be filled, and essentially that corporation is liquidating its existence. Okay. What happens to the shareholders in that situation? Well, it depends, all right, which is, of course, the best tax answer in the world. Non-corporate shareholders, so you and I, would have a fully taxable transaction, okay? So it is a full payment in exchange for the stock transferred, okay? So what are we going to do? We're going to compute our capital gain or loss by subtracting the stock's basis from the money, and if we receive property, and then that is going to be our capital gain, okay? And then if we assumed any debt, that's going to reduce the amount that we are deemed to have received. Okay, corporate shareholders that own 80% or more are not going to recognize a gain or loss on the receipt of this liquidating distribution, because the tax basis in the property transferred carries over to the recipient. Okay, so why is this? Well, they're under common control, and so this allows them to reorganize their corporate structure without tax consequences. All right, so we had talked about the results to a shareholder, but this is related to the corporation. So what happens to the corporation? Well, the liquidating corporation recognizes all gains and some losses, all right, if it's a taxable distribution of property to shareholders, okay? So this is when it does not recognize a loss, okay? Back one slide. So you don't get to recognize a loss if it's distributed to a related party. That's pretty consistent throughout the code, right? If the distribution is not pro rata, so if it's not based on amount of shares or percentage of assets owned, okay? So then they don't get to recognize the loss. And then if the asset distributed is disqualified property, all right, you also don't get to recognize those losses. And hold on one second, let's go bring that out, because now we have a little bit of a discussion about what is disqualified property in these situations. And basically, if you acquired that property within 5 years ago, and it was a tax-deferred transaction that allowed you to acquire that property, you don't get to recognize a loss now on your liquidation, okay? And the reason for that is it would be double dipping. If you had a tax deferral upon its acquisition, you don't get to recognize a loss when it's distributed. And the next slide is going to discuss that a little bit further. So let's roll forward. All right. So essentially, what are we doing? Well, by not allowing the loss on disqualified property, all right, it prevents a built-in loss, right? And it's called an anti-stuffing provision, And so what it prevents folks from doing is contributing property that have losses and then liquidating that company and then allowing that corporation to recognize the loss on the liquidation. Okay, so it's just a way to disallow loss recognition on property that that didn't have a tax consequence initially. Okay, now what about liquidating distributions that do not result in a tax implication? Okay, so again, these are from the corporation's perspective, corporate perspective, okay? And so the liquidating corporation doesn't recognize a gain or loss if it's distributing property to an 80% corporate shareholder, okay? And then it talks about what expenses, okay, are deductible. And notice that would be its final 1120, because remember, if it's liquidating, it's no longer going to be in existence, okay? And then any deferred or capitalized expenditures. So organizational expenditures, remember that you can deduct a certain portion, but then they have to be amortized or capitalized over a number of years, okay? Those are all fully deductible on the final tax return, okay? That is all of the topics that we are going to cover for Chapter 8. I will be doing a Section 351 problem for Chapter 8 as well. So stay tuned for that video.